Good morning, everyone, and welcome to Monday, the 24th of August, 2015. It's going to be a big week. It's already started out as a big week. The Aussie got knocked earlier, rallied back to 73 cents. It's now down at 72.69. That's only 60 points or so above the 6-year low. And even though it's been holding up pretty well lately, the carnage that we saw on markets on Friday night with the Dow down 530 odd points, the S&P and the Nasdaq all down 3% as well. Europe under acute pressure with all markets down either side of 3% is not normally a scenario where the Aussie dollar would do well. But if we go backwards a little bit and talk about what's driving the markets at the moment and what's going on, of course, on Friday we saw the weak Chinese flash PMI coming in at 47.1. The market had expected 47.7, down only slightly from 47.8 the month before. So that was a big miss and really highlighted that China is slowing and slowing fast. It also highlights that potentially China could have to devalue more. It highlights the problems with the Shanghai stock market, and Shanghai was crushed again on Friday afternoon, down 4.21%. It was really interesting price action in Shanghai. And even though the government's announced it's throwing more money at the market, the reality is that this is global selling now. So in the same way that the RBA only ever intervenes to smooth and test and where it can actually, without drawing a line in the sand, I should say, the Chinese might want to do the same. Otherwise, they're going to have some serious problems with face because it's going to be very difficult unless they shut that market or really do basically buy every stock to stop things. So China was a butterfly that flapped its wings on Friday. But realistically, what we've seen over the past few months is that the momentum within the market has been slowing. The prices in the S&P 500 and those sorts of indices have stopped rising. They've flatlined, even though we've had marginal new highs and that sort of stuff. They've been flatlining for some time. That's how we got the death cross in the Dow a couple of weeks back. That's how we got the S&P breaking lower now. Now, you might say, well, okay, the selling was on the back of China, and that's kind of right. But what's happened is that the balance between the buyers and the sellers, or the bulls and the bears, if you want to put it that way, has changed. That's what allowed the death cross to form. Now, as we've discussed previously, a death cross is not a guarantee of cash. But what happens when you get those big crosses in the moving averages that everyone looks at is it changes people's psychology. They start to worry about bad news having an impact. Whereas previously, when the market was in a bull trend, bad news can be dismissed because we're in a bull trend. But if we turn into a bear trend, which is kind of what a death cross points to, people start to think, maybe I should take some money off the table, that kind of stuff. And so you end up with, it feeds on itself, the market feeds on itself, and you end up with anything negative being, doubly or triply as important as things that are positive. Where we are now after last week, we've got the S&P down 5.8, Dow down 5.8% on the week, the Nasdaq down almost 7, FTSE lost 5.5%, and it was a good performer. The DAX lost 7.8, and if you've been watching for the last couple of weeks since I've been doing this, I've already achieved the first 1,000 of my 2,000 points. I thought the DAX might fall. Nikkei was down 5.28%. Hang Seng's down 6.59. Shanghai was down over 12% last week. That's phenomenal for a market that's trying to be propped up by the government. The Aussie market was only down 2.65%, but it lost another 2% in futures trade with a SPY 200 contract off 110 points on Friday night. So it's going to be an ugly close. Gold's up, but gold's crashed into my slow-moving average at the moment, and it's really struggling. Excuse me, showing you the side of my head. It's really struggling to get through anytime now. If I go to the weeklies charts, where are we? Yeah, it's struggling to get up. It's 1168, something like that, is kind of the level it needs to get through to really kick on. Gold's persistence last week was what told me that the stocks were going to go off because it was people were buying it because they were worried. The Aussie falling today is another indicator, but it's early Asia, so we're not going to get too excited about that. Oil traded under $40 on Friday, which is important, even though it did come back. Now, I've put out my diary for the week ahead at Business Insider. I always put it out on a Sunday afternoon, Sunday evening. It normally comes out about 6:30, 7 o'clock. So it's there if you want to have a look at the outlook for the week ahead. I think the key thing, a couple of things you should probably look at. Have a look at Henry Blodgett's article about where the stock market is at the moment. It's on Business Insider, and you can link it through my Oz diary. So look for Australian diary, everything you need to know about the week ahead. There's a link to Blodgett's article. It looks at where the market is. And the good point he makes is that he's looking at the PE ratios of the market where it is at the moment. And he says, in fact, it is higher than at any point in the 20th century, with the exception of the months that preceded the two biggest stock market crashes in history. Now, I've been cashed since last year, since April last year. I was early, too early. So I missed the opportunity to trade my super when I put it all in cash. I should have traded it because there was a clear buy signal last year that took us up to 6,000. And anybody who reads my reports at Business Insider or at Go Markets knows that at 6,000, I said, this is the top, this is the top, this is the top. Then called 5,300, then 5,150, and it probably looks like it's going to 4,800. So I missed the trading opportunity for my super. On my trading account, that's different, but there's more money in my super. So I've missed that. But I'm back in the money because this is the kind of thing I thought was going to happen. I thought this kind of market funk was going to happen for a long time. And I've always said to people I was going to buy the rally of 2017. Now, whether or not that happens, we'll have to wait and see. I genuinely don't know. But the S&P has broken its uptrend that goes back to 2011. So this is the QE rally. This is our break last week. This is the QE rally. On a short-term basis, you've got to say that that's oversold, seriously oversold. But if you think about it, my indicator that got me long, right? This is my moving average cross, 15 and 30. This is the one I use all the time. Got me long down here. It's been long the whole way. It hasn't yet crossed over. So I'm not mega bearish by any sense of the imagination. But if it does cross over, then that'll be a good signal. It's not perfect, as always. But you'd have to say that somewhere down in the 1800s is really possible for the S&P 500 sometime soon, would be my guess. So anyway, we'll see what happens there. Looking forward to the week ahead, we really do have quite a big week. In Australia, we've got some important partials, CapEx in particular, which is out on Wednesday, I think. Sorry, CapEx is Thursday. Construction work done's on Wednesday. CapEx is the key to everything in Australia. We've been watching it because after the mining boom, it's been difficult for the Australian economy to generate growth because that's been such a big hole and a hole that nobody can really jump over. So CapEx is going to be really important. So far, we haven't seen the non-mining sector pick up. RBA Governor Glenn Stevens is talking on Wednesday, but they're just remarks, so it's unlikely to be a big speech, although I'm sure he will get asked about the market at some point. If you turn offshore, it's a fairly light week for China. PBOC leading index on Tuesday, Westpac M&I sentiment on Wednesday. They're important, but really market price action and what the RMB does are probably going to be key. Chicago Fed National Index in the States tonight. Japanese leading indicators today. German GDP tomorrow night, NIFO business survey, along with Case-Shiller house prices in the US. If you trade Kiwi, Wednesday morning trade data, going to be really interesting. Obviously, the dairy auctions and those sort of things could, and the prices that have fallen, even though last week was a really good auction, could surprise a few people on the trade, but I'm sure that should be factored in. We also get a speech from New York Fed President Bill Dudley Wednesday, which is going to be really important. Thursday, Jackson Hole start. Somehow I thought Jackson Hole was last weekend. I don't know how I mess that up, but Jackson Hole starts this week. Now, this is really important because the topic of the symposium is inflation dynamics and monetary policy. Right here, right now, with oil down at $40, it's going to be some really important. So that'll be interesting, because in just 1 week, the outlook for the Fed has really changed, and tightening expectations are down at 35%. Thursday is going to be big. US GDP Thursday night, and personal consumption expenditures as well. That's going to tell us, what the likelihood of a Fed hike is. But if the markets continue to go off as they might, then we are, the chances of a Fed hike are going to be pushed back. Benoit Mandelbrot, or Benoit, I should say, Mandelbrot told us that volatility clusters. We know that the reason it clusters is that people get scared, people reduce their position sizes, they don't buy with as much gusto, and that means the path of least resistance for the sellers is down. In this sense, and right at the moment. That's unless we get a circuit breaker. Now, a circuit breaker could be something from the Fed. A circuit breaker could be something from China. But we'll have to wait and see. For the moment, the bears have it. So if you're like me and you like bear markets, whether it's the Aussie dollar falling or bonds rallying or just prices that go down, then you're going to make some hay. But most people don't like these type of markets. They don't like this type of volatility. It scares them. And that's what makes downside probes so aggressive. We haven't seen a pessimistic crescendo yet. That's From me, have a great Monday. Good luck. All the best. Keep your position sizes relative to your risk tolerance, and you'll get through whatever market conditions are out there and face this over the next day and weeks without too much trouble. All the best. Bye for now. I'm Greg McKenna.